Hey guys, it's Nick, and in this video I want to talk about what's going on at Robinhood. Just a few days ago, the CEO of Robinhood was on the financial news programs, and he was saying that they didn't have a liquidity problem, and yet after that they went and drew down $500 to $600 million in loans from their revolving credit facility with banks. After they did that, he went and got a $1 billion additional investment from other investors. Now, part of the reason they're doing that is because of increased margin requirements from the Clearinghouse, DTCC, and that goes for all brokers because of the increased volatility in these short squeeze stocks like Gamestop and AMC. But curiously, after they got that $1 billion investment and after they got that $600 or so million loan from the banks, on Friday, you can only still buy 2 shares of GameStop and reduced amount of shares of some other of these short squeeze type of stocks. This was around like 1:30 in the afternoon on Friday. But after the close, they went and updated the list of stocks that you can only buy 1 share of. And that list is like 50 stocks now, where 36 of them you can only buy 1 share. And that includes even names like Starbucks and GM, and of course the usual suspects, GameStop, AMC, BlackBerry, and all of those kinds of stocks. So apparently that $1.5 billion they got is not enough for whatever cash crunch problems they're having. So people are thinking 2 things about Robinhood. One, to move their account to another broker because they're angry and maybe they're a little worried about, is Robinhood safe? And the other is it possible that Robinhood goes bankrupt over this, that they still don't have enough money for margin, and maybe because of losses in their customers' accounts that don't have enough margin to pay off these losses? That's also a possibility. I don't know. I'm not trying to cause a run on Robinhood or any other brokers, but this is kind of, it looks like it's turning out to be a precarious situation with the brokers and the clearinghouses. Now, if you don't know, brokerages have a type of insurance called SIPC. It's not FIDC like the banks have, which is federally backed. SIPC is a group of brokers that pull their money together. They pay dues into this SIPC fund to insure brokerage accounts. So I'm going to talk about what that is, what that isn't, how much it insures your account for, and potential problems with it. And also I'll look at what it takes to move your account from Robinhood. So today, Saturday, Zero Hedge has an article, has the Robinhood exodus begun? And the search term delete Robinhood is up a lot, and people are asking questions like how to delete Robinhood, delete my Robinhood account, how to delete a Robinhood account, and so on. So I'm not just picking on Robinhood. In this article it says it's not just Robinhood. The Reddit rebellion has clogged the entire financial system's plumbing, and they talk about how the clearinghouses work and what can go wrong, especially if one broker has customers that have big losses. That could affect other brokers and could affect the whole system. So this is really seems to be kind of precarious with what's going on here. And this is a representation of what it's starting to look like. So Robinhood and other brokerages are changing their margin maintenance requirements because of what's going on. And so in this example, they say if you bought 10,000 shares of Meow and put up 25%, that means you have to have at least $2,500 in your account. More typically, it's a 50% margin. And so if you bought 10,000 worth of stock, you have to have $5,000 in there. However, if the stock falls more than 50%, then you're down more than $5,000, meaning you're wiped out and the brokerage is now losing money. And so if you want to keep the position, you have to put up more money. Now, a lot of these brokerages are going to 100% margin for some stocks or options, and so that means people are going to have to put up the total amount, not just 50%. And if you ever read the margin disclosure statement on Robinhood or other brokerages, you might see some eye-opening things here. 1, you can lose more funds than you deposit. 2, we can force the liquidation of sale or securities or other assets in your account. we can sell your securities without contacting you, which most brokerages do. They typically don't wait that long to liquidate your account if the market is moving quickly. Also, you're not entitled to choose which securities or other assets in your account are liquidated. So if you're long GameStop and you have to meet a margin call, they could sell your Microsoft out from under you as well. Also, they can increase house maintenance margin requirements at any time and not required to provide you advance written notice. So if you put up $5,000 to buy $10,000 worth of a stock, they can say tomorrow, oh, by the way, no, we want $10,000 for that stock. Otherwise, we're going to sell it on you. Robinhood and other brokerages can hypothecate the securities in your account and rehypothecate your securities. What it means is they can loan it out to somebody who loans it out to somebody who loans it out to somebody. And so that third or fourth person it's loaned out to, if they fail or they go bankrupt, then there's all kinds of problems in the system that if there's enough of them with not enough margin deposited at DTCC, it could be a chain reaction and you get the clogged up toilet like I showed you just a second ago. Now, for those that are pissed off or worried about their account at Robinhood and want to leave Robinhood, you can do that without having to sell your stock or your positions, and it's called a ACAT, or account transfer, outgoing. Now, Robinhood has zero commissions for stocks and stuff like that, but if you want to transfer your account out, it's $75. So what you would do is you would open another brokerage account someplace, and then they usually have a process to account transfer from your brokerage at Robinhood to the new brokerage. They do it all the time. It's not a big deal. So you would just fill out the ACAT form and they do it for you. You don't even have to contact Robinhood. Usually the new broker will take care of that for you if you want to leave Robinhood. Now, if you want to stay at Robinhood, but you're a little scared that maybe they don't have enough money for the margin, or there was big losses in their customers' accounts that they can't cover, what's your risk of your money in your account, and is it insured? And yes and no, it is insured, but let's see what this insurance is. So brokerage insurance is called SIPC, and it's been around for about 50 years now. And it's a nonprofit corporation that's been protecting investors for 50 years, blah, blah, blah. It's basically a group of brokerage firms that add money to a fund to insure any kinds of bankruptcies in brokerages to make customers whole if that happens. So what does SIPC insurance cover? It covers money in your brokerage account up to $500,000. That $500,000 includes up to $250,000 protection for cash in your account to buy securities. So what that means is you can have, say, up to $500,000 in stocks in your account, and that's covered, or up to $250,000 in stocks and another $250,000 in cash, and both of them are covered. However, the way it's worded, it sounds like if you have more than $250,000 in cash only, so say you had total $500,000 in cash, you're only covered for the first $250,000. And SIPC protection is only available if your brokerage firm fails and SIPC steps in and you have to file a claim. And you're not protected if your firm's not in SIPC, but almost all of them are. You're not protected for a market loss on your stock positions, or promises of investment performance, or commodities or futures contracts. So if you're buying futures contracts in your account, you're not protected by SIPC. So that sounds great, right? The average Robinhood account is like $1,500 or so, as I'll show in a second. So it sounds like you're totally protected, right? And again, I'm not picking on Robinhood. I'm not saying they're going bankrupt or whatever. I'm using them as an example because of the problems they're having this weekend. But let's take a look at the SIPC fund, meaning how much money do they actually have in this insurance fund that they protect all of these brokerage accounts? Well, let's see. 2019, they got $3.5 billion approximately. Sounds like a lot of money, right? Well, let's see. So let's compare the SIPC insurance fund to how much money is actually in brokers all over the country. And the biggest brokers, Vanguard, Schwab, Bank of America, look at these numbers here, 6152. That means 6.15 trillion or 6,000 billions. So the SIPC fund is 3 billion. How are they going to cover 6,000 billion in a Vanguard, or 4,000 billion in Schwab, or 3,000 billion in Merrill Lynch, or 3,000 billion in Fidelity? So that's the problem with SIPC having $3.5 billion when these brokerages have trillions of dollars under management. So if something happened and there was a big blow up, $3.5 billion is nothing even for just to cover one brokerage like E-Trade, which is $678 billion. So let's see how much Robinhood has. So although Robinhood has a lot of accounts, 13 million accounts, their assets under management is tiny compared to the big guys. So E-Trade, like I said, 600 here, 678 in the other one, but compared to Robinhood, only 20 billion. So if you take 20 billion and divide by their 13 million accounts, that's about $1,500 account on average. Even so, if Robinhood just lost, 15% of its clients' assets through losses on these short squeeze stocks or options blowing up or something along those lines, SIPC barely has enough money to cover that, okay? So I'm not pointing this out to show that it's a Robinhood problem. It's a industry-wide problem that as long as things are going good, the insurance isn't needed. But if the insurance is ever needed, it's not even a tiny, 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 tiny drop in the bucket versus how much assets are out there. The amount of insurance versus the amount in the accounts in brokerages is kind of like the elephant and the rope, where in India they tie an elephant to a stake with a little thin string, and the elephant could easily break away if it thought it could, but it doesn't, because it's been taught that that rope can hold it to the stake since when it was a younger elephant, and the rope actually could hold it. So all these years later, it just believes that this rope is strong enough to hold it. And so that's what people believe, that the brokerages are insured enough that if something goes wrong, their account is insured. That's not necessarily the case. So guys, if you want to delete your Robinhood account because you're mad at them or you're worried about what's going to happen, you can do an account transfer for $75 and transfer to another brokerage. If you're worried about their solvency and a possible bankruptcy because of their margin requirements and possible customer losses, especially because they trade so much options compared to everybody else, it's a real possible risk, I would say. I'm not saying it's happening, but as you see, the insurance is there and it does cover you. However, it doesn't cover you enough in Robinhood, in Vanguard, in Fidelity, in any of the brokerages. So that's why I say always spread your money around, have a few brokerage accounts, because you never know what's going to happen. And if they try to pull one of these things where you can only buy one share of stock, you can go to your other brokerage and do it there. So have some flexibility, have some options. So guys, if you like this video and you found it informative, hit the thumbs up button, and I'll see you on the next one. Thanks for watching.